This lesson has several exercises related to the previous two lessons on capital budgeting. Here's our first problem. Given an initial investment of $70,000 and a projected yearly cash flows $5,000, $7,500, $10,000, $12,500, $15,000, $17,500, and $20,000. Compute the NPV for rates of return, cost of capital of 2, 3, 4, 5, 6, and 7%. I'll show you the answer on the next slide. This is pretty straightforward if you've listened to the other two lessons. So I have the answer here for our exercise number 1. The information we're given is shown up in the table at the top here. You have the number of years, the initial investment, and then the net cash flows. Then you have the calculation for the NPV based on different cost of capital. And you can see that there's a positive NPV up to 5%. And then after 5%, you start getting into negative territory. So depending on what you believe is the risk equivalent to the investment, I'll just give you a particular example. Let's say we believe the risk equivalent to the investment is 3% a year, then of course you would go ahead with the investment because the NPV is positive. However, if you thought your investment with, let's say 7%, in other words, a much higher risk, and then you checked across to see the NPV, you see that's negative, so you're better off investing your money in this whatever alternative stocks or bonds or whatever that this 7% would be in terms of the cost of capital. And just one caution that I fortunately found a mistake that I corrected now. When you use Microsoft Excel to do the NPV, what you want to do is put the rate, the cost of capital, in the first parameter, and then you want to give it the range of the net cash flows. So in this case, it will be like whatever cells these are in. And the mistake I made is I put this into the NPV function, and you need to do this separately. So you have this cell plus the NPV function, for example, with the value 0.02, and then pointing to these other net cash flows, and that will give you the correct answer for the NPV. Exercise number 2. We'll go back to the Acme Furniture Company, which we used in several examples. Here we're going to do a little bit different. They're taking a loan, Alice and Bob, and this time the loan is 10 years at 3% per year with semi-annual payments, and the amount of the loan is $50,000. Further, assume the project returns no cash inflows after the first half of year 6. So you see here we have cash inflows, and then at year 6.5 and out, there's no more money coming in, but the loan persists, so you have to take that into account. Compute the NPV for the semi-annual cost of capital ranging from 2 to 8% in increments of 0.5%. Okay, so what you need to do is, and I guess this is a hint, you need to figure out these payments over the 10 years. And it'll be the same amount, right? It's a mortgage or a house loan, for example. So it will be the same amount. You need to plug that into all these lines. Here is a negative, and then you add the operating cash flow and the investment cash flow to get the net cash flows, and then you compute the NPV. So let's look at the answer on the next slide. I have the solution here on this slide, and I also made the spreadsheet for the first problem as well as this problem available in a Excel spreadsheet, capital budgeting. I'll put that in the GitHub. It's already there actually, and I'll give you the link to GitHub. It also has the amortization program, which you would use to calculate the semi-annual payments, which I'm showing here as negatives. You put those into this row number 3 under investment cash, and they're all negative. And then you just add the operational cash and the investment cash, and you get these net flows. And that's what you use in the NPV formula. Again, you have to do the 225 separately as a negative, and then starting from 0.5 from this cell here to the last cell here, you put that into the NPV function, and you put in these different semi-annual cost of capital. And you see here that up until 5% semi-annual, 10% per year, roughly, you're still positive, but beyond that, the NPV is negative, and you'd be better off investing in the alternative investment in that case, in those cases, I should say. Problem number 3 is a bit messier, more of an experiment. Let's have a look at it. Again, we're talking about the furniture company. And now we're going to reduce it back down to just 6 years, not the 10 years we were talking about in the previous example. What is the maximum amount that Alice and Bob can borrow on the same loan conditions? This is as the original problem. 3% nominal annual interest rate, repaid semi-annual over 5 years. So the loan stops here. And you have these 2 more semi-annual periods. And still have a positive NPV at 2% semi-annual cost of capital. Okay, so that's probably will make you think for a bit. It's what you need to do, and I'll give you the hint, and then I'll show you the solution. First thing is just put the problem down in the spreadsheet. So I did that here. This is what you would start with. And then what you don't know is these numbers here, right? Because you don't know what the maximum loan is. But what you do know is when you compute these net cash flows, the bottom row, you want to kind of have a break-even point at 2% semi-annual. So what you need to do is guess. This is the kind of depending on your nature. If you like experimenting, then maybe it's not a bad thing. But if you're adverse to experimenting and getting your hands dirty in a problem, then you may not enjoy this too much. But you need to populate this, set up the NPV formula just for the 2%, and then guess at different numbers. Now you can just put in one number here and then have all the other entries make use of that. And then you just keep, you go higher and lower until you actually get your NPV coming out at 0. Okay, so I kind of gave you the answer, but I'll show you the details on the next slide. And this will also be in the capital budgeting spreadsheet that I mentioned. It has multiple sheets. The last 3 sheets have the solutions for exercise 1, 2, and then this exercise 3. There's a whole bunch of sheets before that, and they're actually related to the problems I did in the previous 2 lessons. But you're welcome to look at those too and see the details of the problem solutions for the last 2 lessons on capital budgeting. Okay, so here's the answer. If you follow the procedure I mentioned in terms of the loan payment per semi-annual, and you keep fudging around with that, you'll get to $11,158.30, and the NPV is approximately very close to 0 at 2%. So under the stated loan terms, which I just restated for you here, we can work backwards. The amortization program that I supplied you can work backwards. If you know this is the your maximum or your loan payment, you can work backwards to find out what the amount of the loan is. So this is the answer to the problem. 102,904. So therefore, to maintain a positive NPV, Alice and Bob should borrow slightly less than this number here, which make these a little bit less too, right? Which would be less amount being subtracted from the money they're making. And as I mentioned, this is in a spreadsheet, and you need to look for sheet EX3. This is actually the last sheet in this spreadsheet. So you're going to need to go to the bottom and then use a little scroll button to go all the way over to find that. And what it'll have are the charts I showed you on the previous slide, populated with this number here, and then also it'll show you the NPV calculation. Use the Microsoft Excel IRR function to compute the IRRs for projects A and B as described in the table below. This is an example we saw earlier in one of the earlier lessons on capital budgeting, and the task is pretty easy. It's just to familiarize you with the IRR function in Microsoft Excel. So I'll give you the answer on the next slide. Okay, and this is the answer, just so you can double check what you have. 6.131% for project A and 6.36% for project B. Use the Microsoft Excel MIRR function to compute the modified IRRs for projects A and B in the example shown below here. Same thing this is the same as we had in the previous exercise. Assume a reinvestment rate of 0.015 and a financing rate of 0.025. Do the calculation again with a reinvestment rate of 0.08 and a financing rate of 0.06. Okay, so I'll give you the answer to this on the next slide. Again, it's pretty much straightforward. It's a matter of just learning how to use this function and what the parameters are. And I've given you the various information you need to do this. And here's the answer. In the first scenario, the MIRR is 3.96% for project A, 3.95% for project B. In the second scenario, we get 7.15% for project A and 7.20 for project B. Okay, so that's the last exercise in this lesson, and that's basically the end of my lessons on capital budgeting. I have some more lessons on stocks, which I'll follow up after this.